Raytheon Technologies, a newly formed company from the merger of United Technologies and Raytheon, is a stock that I've been getting a ton of requests to cover here on the channel. After the merger and adjustments to the stock price, Raytheon Technologies now currently sits down over 40%, and this has many investors asking the question, is this stock a buy here at these levels? So what we're going to do in this video is take a closer look at this company. We're going to evaluate its financials, its fundamentals, and then we're going to try to figure out if this company does make sense as an investment. What I also want to do is take the time to compare this company to one of its biggest competitors, Lockheed Martin, take a look at their valuation briefly, and then try to draw a comparison between the two to see if Raytheon Technologies is actually undervalued compared to its peers. So this is going to be a fun video, guys. Drop a like down below if you appreciate this video. It is a subscriber requested video, and if you want to see any other stocks covered on this channel, let me know in the comment section down below. So at a high level, if you're not familiar with this company, it is a giant really in the aerospace and defense sector and competes with companies like Lockheed Martin. Most specifically, they provide advanced systems and services for commercial, military, and government customers worldwide. Raytheon Technologies has four main businesses, which is the Collins Aerospace Systems, Pratt & Whitney, Raytheon Intelligence and Space, and Raytheon Missiles and Defense. All of these together help make up this $87.5 billion giant. Now, it is difficult to look at this company's fundamentals because after the merger, we don't really have a consolidated balance sheet available right now because they did report separately and then merged after that. So we'll have to wait until the next earnings report to get a proper consolidated view. But what we can do, guys, is look at future predictions for this combined company and then compare it and evaluate it against its peers. In 2020, this company expects revenues of $65 billion with net income of only $3.5 billion. However, in 2021 and 2022, these are expected to significantly improve, with the revenues growing to $71.4 billion and $76.5 billion respectively, and net income growing to $5.9 and $7.2 billion respectively. If these estimates hold true, the company would have a PE of only 12.5 in 2022, which would be cheap in my opinion when you consider the growth that revenues and income is expected to grow by. So along with being a profitable company, they are also expected to be positive free cash flow going forward. A little over $3 billion in 2020 is expected, $6.1 billion in 2021, and $7 billion in 2022. So this is another positive metric trending in the right direction. All of these projections here for this growth company tells me that it's a healthy business that's expected to grow quite substantially over the next 3 years. Now, this new combined company, along with this growth, will automatically qualify as a dividend aristocrat here according to Seeking Alpha. It'll have a starting yield of 3.24%, a 60% payout ratio, which is 100% manageable in my opinion, and a history of growing this dividend for 26 consecutive years. Based on these fundamentals, this new combined company looks like a very strong option for a dividend growth company and a growth company, especially if you're looking for some exposure to the aerospace industry. Now, like I mentioned, it's kind of difficult to make a decision here as an investment solely on this new information unless you are familiar with the individual companies prior to this, United Technologies and Raytheon. But if this new combined company is new to you, we need to do a bit more analysis here on their competitors to see what the industry standard looks like. So here we have some information on one of their biggest rivals, Lockheed Martin, and we can see that projections for 2020, 2021, and 2022 right off the bat look very similar to Raytheon Technologies. But the difference is that Lockheed Martin is a company that's trading at a premium here with a market cap of $105 billion. Their revenues are expected to come in at $63.4 billion in 2020 with a net income of $6.7 billion. And in 2021 and 2022, revenues are expected to grow modestly to $67 and $70 billion, and net income follows at $7.3 and $7.8 billion respectively. So the growth here isn't too crazy when compared to Raytheon Technologies, but it is expected to just be a slow and consistent company here over the next 3 years. Free cash flow for the business is also expected to remain fairly sustainable and fairly strong, averaging around $6 billion every year. So you can see when we compare these two companies together, which are fairly close competitors, they have very similar revenues, they have very similar incomes, and they have very similar free cash flow numbers as well. One of the main differences though that I see is that Lockheed Martin trades at a $105 billion market cap, whereas Raytheon Technologies is around $87, $88 billion market cap. In 2022, if everything goes well, Raytheon Technologies is expected to earn around $7.2 billion on $76.5 billion of revenue, And when compared to Lockheed Martin, they're expected to earn around $7.8 billion on $70 billion of revenue. Yes, Lockheed Martin is more efficient here with better margins, but Raytheon Technologies is expected to widen its revenue gap with Lockheed Martin. And with growth and size over time, if this trajectory continues, their earnings as a dollar amount will be larger than Lockheed Martin in the next 5 to 10 years. So now when comparing these two, there's one of two things really. It's either that Lockheed Martin is overvalued or Raytheon Technologies is undervalued. Maybe there's a case where both, one is undervalued, one is overvalued, and the fair value is somewhere in between, but I did a bit more digging here to get a better understanding. Now, if you take a look at the dividend yield history here for Lockheed Martin, yes, they pay out dividends as well, you could make an argument here that they may actually be undervalued at current prices. Now, you could make an argument as well that Lockheed Martin is actually fairly valued based on its historical metrics. So we're either looking at an undervalued company or a fairly valued company when comparing their dividend yield history at least. When we look at the historical PEs, it shows us that it is indeed a bit overvalued here when compared to the usual range that it trades at. And based on the information here, it seems that around a 10 PE or so would be fair for the company, but we're trading a bit higher than that right now. So I mean, we're getting some mixed signals here for Lockheed Martin on their valuation, but based on the information that we have, stock price $377 per share, market cap of $105 billion, PE of 17, and a dividend yield currently of 2.54%. I think that Lockheed Martin is on the higher end of fairly valued, or even maybe on the lower end of overvalued in my opinion. So just based on this alone, I can kind of draw a conclusion here that when we're comparing these two peers together, they're competing in the same industry, they go for the same type of customers, they create similar types of products. If we say that Lockheed Martin is either, fairly valued or slightly overvalued, then I think that Raytheon Technologies would actually be undervalued at today's prices. It's trading at a lower market cap, a lower PE, has a higher dividend yield, and has better growth moving forward. So it doesn't really add up to me why this company is trading at a discount when compared to its peers, especially when it has similar growth paths ahead. And to me, guys, if I had to pick one of these two companies, Raytheon Technologies is the no-brainer here. It is providing better value, and in my opinion, is a better buy today if I was looking for a company in this space. This is probably why a lot of you guys have been requesting for a video on this, and I'm glad you brought this to my attention because it is a stock that I do want to understand a bit better, and I'll be looking forward to their next earnings report, and I'll be listening to that earnings call to figure out what the new merged company looks like with their financials, balance sheet, and all that kind of stuff. Now, don't get me wrong, this does not mean that we're at the bottom here for Raytheon Technologies. This does not mean that at this price today, we're going to get the best value in the stock. It's quite possible that we see even lower prices in this industry as a whole because, guys, the aerospace industry is suffering right now. You guys know what's going on with Boeing, and if you don't, check out the videos that I have on my channel that I cover Boeing in. Pretty much, there's a lot going on behind the scenes here, and these companies are going to be hurt in the short term. There is definitely going to be some slow revenue growth in the next year or so. There's going to be lower profits in the next year or so, and we're probably going to see a lot of layoffs in this industry as well in the next year or so. So there's a lot of pain still ahead in my opinion, but if you have a long-term outlook and you're a long-term investor, today's prices for Raytheon Technologies does look pretty enticing. With the stock being 40% off its highs, a PE that's pretty reasonable in my opinion, and a pretty sustainable starting yield as well, it's hard to really say this is not a good investment to consider when you weigh all the pros and cons here. So like I said, I'll be looking more into this company. If you guys want to hear even more on this company, let me know in the comment section down below. I can probably create a video on this once they release their next earnings the next quarter. But in the meantime, guys, let me know what you chose to do with this stock, whether you chose to buy into it. I know some of you have been buying the stock recently, and if that's true, I want to hear your bullish thesis on the company in the comment section down below. Guys, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.